Episode 3, we're going to talk about structures this week. Structure basically means once the advisor has decided what he's going to do with you, he's going to put you into either a retirement annuity, tax-free savings, endowment, annuity, something like that, or a combination of those. So we're going to talk about what are these pros and cons, tax advantages, flexibility, all that kind of stuff. Okay, so basically we're going to discuss the 5 most common types of structures or policies, products that you can put your investments into, which will give you the tax advantages and certain other advantages over time. Most common and easiest to understand, number 1, is a discretionary investment. That's basically just your money invested. It's not structured, it's not wrapped, it's nothing. No tax advantage. You're going to pay your dividends tax, you're going to pay your capital gains tax, you're going to pay interest tax each year. And this discretionary can either be local or offshore. And this is basically the only way you can actually get your money directly offshore. You can't do it in any type of other structure. So discretionary, number 1. Number 2, I'm going to talk about the biggest, most tax advantageous structure that you can possibly do, and that is your retirement annuity. This is the thing that's going to help you retire one day. Alright, so retirement annuity is the government incentivizing you to look after yourself in retirement. How do they do that? Basically, anything you put into an RA up to limit each year is a direct deduction on your income tax. You can contribute into a policy or a structure that does not allow you to access your money until you're at least 55 years older. Different types. Normal retirement annuity. You also get a pension fund or a Provident fund. That's when your company saves for you. Preservation fund is if you leave your employer and you need to do something with your pension or provident fund, you leave it into a preservation fund. Tax advantage is massive. Very good. Next thing, what happens when you do retire one day? These retirement savings need to go into a new structure. That is living annuity. Or otherwise also a life annuity. Okay, what that is your accumulated retirement savings put into another product or structure that is able to pay you out a monthly income. Main options, the living annuity. That means your retirement savings are invested and you take a percentage of that each year paid out to you. It allows the money to still grow and you can bequeath it on your death. Life annuity, it's a contract with an insurance company to guarantee that you are paid a certain percentage each and every year regardless of what happens to the market. That's what you need to do with your money once you've retired. Okay, quite an exciting one, especially for young people. Alright, tax-free investment, otherwise known as tax-free savings account. Brilliant new incentive started by the government. What it is very low restrictions, total flexibility. You can put 33,000 Rand a year into this investment and all the growth is totally tax-free. So it's a great little incentive to get people to save for just saving's sake. So not retirement, not anything specific, but you get a nice little tax advantage to save. And then the last one, we have an endowment. Okay, an endowment, not as popular these days, but effectively what it is the old school version of a tax-free savings. So an endowment, you give your money to an insurance company, it's locked up there for effectively 5 years, and all the tax that is paid within this account is capped at 30%. So it's actually only valuable to people that have an average tax rate of above 30%. That's just there because it is still quite common, and also advisors or brokers love selling this thing due to the high commissions and fees back in the day. So it's still there, it has its place, but as you can tell, very boring. I can just give you some evidence of that. My director fell asleep while I was discussing this. So I'm just going to quickly go how does the tax work on each of these?
Discretionary, fully taxed. Retirement annuity, growth, totally tax-free. Contributions tax deductible. When you take out the money, a certain portion is tax-free. Living annuity, growth is tax-free, but everything you withdraw, gotta pay tax. Tax-free investment, growth is tax-free, withdrawal is free of tax, but you don't get any tax deduction. Endowment, tax maximum 30%.
So that's it. There you go. 1, 2, 3, 4, 5. Very high level glossary type summary, but at least you're getting an idea of some of the terms of what are these things called. I'm definitely going to do a video on each one in the near future, fully broken down with examples so you can see how do the taxes actually affect you. Also, these are South African specific type products, but the same incentivized structures exist in most other countries. So you can just Google what is the equivalent in your area, like United States would be an IRA, things like that. So hope you learned a little bit of something. Like and subscribe, and see you next week.